As I hop over here into M1 Finance, I notice that I need to make some changes. I see my growth portfolio, I see the 4 stocks that I own, and I see that it all lines up. It looks good, but when I look at my dividend growth portfolio, I am concerned. And more importantly, I'm concerned about one investment, and that's one that we're going to talk about today because we did have 20 holdings in the portfolio, and now we're down to 19. What did we sell? We sold Verizon. Verizon is no longer a part of this dividend growth portfolio, and we're going to talk in this video exactly why that is. We're going to talk about the overall business, the fundamentals for the company, the reasons why I decided to sell it, and all the good and bad things of Verizon. We're going to talk about the guidance for 2022, their outstanding debt. We're going to talk about all that good stuff, and if you're an investor in this company, I think you should be concerned. While I don't think it's the worst investment of all time, and I don't think investors are primed to lose a lot of money, I think the upside opportunity is really negligible. I think the upside, it's much more limited, and the downside is a lot more prone to go down further because the opportunities, in my opinion, just aren't as great as the upside. Now, if you want to invest like me, if you want to follow along with my portfolio, this is shared down below in the description, and you can see this is written down here through all these links down below. So take a look at that, take advantage of this opportunity, and get signed up for a free $10. If you get signed up, you'd help support me and the channel. 133 people have signed up so far. But other than that, guys, thank you so much for tuning in. If you want to see it, if you want to check into it, you can see my portfolio balance being 42,600 right now. And if you want to pause the video and take a look at my month-over-month portfolio balance, my portfolio holdings, my performance versus the major indexes, my monthly or lifetime YouTube income, all that good stuff down below. But other than that, guys, let's go ahead and jump straight into how Verizon is making bad financial decisions, in my opinion, and how I think they could improve on them. Now, let's look over the last couple of quarters and let's see how Verizon is doing on growth. Now, in the most recent quarter, they grew 4%. Now, already, this is one of the best quarters that Verizon has put up all year. It actually is the best quarter Verizon's put up all year, and it grew only 4%. Now, 4% isn't terrible considering we're in a recession. It's very defensive, but it's also not the greatest growth you can find either. There's lots of great companies in the market, and 4% is nothing to scoff at. Now, for example, if we look at the 4 companies I own, you see massive revenue growth. I like to invest in growing businesses in my growth portfolio. Salesforce is growing at 21.77%. My second largest position, which is Amazon, as of the most recent quarter, is still growing an astounding 14.7%. Google, the slowest one of all, is still growing much faster than Verizon. It is still growing with its worst quarter this year at 6%. And then lastly, you see Crocs. Their numbers is a little bit different because they did have a major acquisition, but still, nonetheless, they grew revenue 57% year over year. So when you look at Verizon, you compare this to some of the growth companies that I own, it's obvious to see that Verizon is not a growth company. Now, you might be looking at this quarterly report and saying, Jordan, they haven't been growing very much in 2022. Maybe it's because of the recession. Maybe it's because of their business model. But regardless, they might be projecting more growth in the future. Well, let's take a look at that. Let's look at their guidance for the rest of 2022. And Verizon themselves is projecting that service and other growth is going to be -1 to flat. And their adjusted EBITDA growth is going to be -1.5% to flat. And you can see that really the one thing that is keeping this company afloat and keeping it just anchored at that share price at around $30 is the adjusted EPS, which is around $5. Now, that's the one cool part about this company is that historically it's produced a lot of free cash flow. If you look over the last several years, it's produced tens of billions of dollars in cash flow, with 2020 being $21 billion, until we get to 2021, which had a negative 232% downturn, which had a negative free cash flow number of $28 billion. Now, before I criticize this negative number, it is not as big and scary as you might think it is because they're spending a ton on CapEx. If you look at their CapEx year over year, they're investing big in 5G. In 2020, they invested $20 billion back into the business. The next year, they invested $67 billion, almost 3.5x of what they did the year before, and that's the reason why you see these negative free cash flows. One of the big bright spots of Verizon is the growing dividend, and one of the reasons why it was in the dividend growth portfolio, how it's consistently grown year over year, and last year they raised it 1.95%, and it's been growing about 2% over the last 10 years. However, 2% in my opinion is not fast enough. Let me give you an example. Let's hop back into the portfolio here and let's look at these dividend growth stocks. Even some of the slower growers, okay? Let's take a look at WP Carey, which in my opinion, which is one of the largest holdings in the portfolio, is one of the slowest growing dividend growth stocks in the portfolio. If you look at its dividend, over the last 10 years, it's grown 4.86%. If you look at next up, the second largest position in my portfolio, which is tied with WP Carey, which is JP Morgan, its dividend has grown over the last 10 years 12%, okay? So it is growing much faster for most of these companies, and Verizon has not been able to hold up, which is another reason why I decided to sell it. Now, lastly, the main reason why I'm concerned about Verizon is not just because of the lack of growth. The growth is very, very boring. It's very slow. It's not an exciting company. But you have two major reasons which this company has destroyed shareholder value, which is because of A, dilution of shareholders. You see how the company stock has continually gotten more and more diluted. In 2013, they had 2.8 billion. Then they did a big dilution in 2014, and they've consistently raised shares, not bought shares back. If you look over this over the last couple of quarters, you can see when this has started to trickle up right around 2021 from its 4.1 billion shares outstanding. Now it's trickling up to 4.2. So your ownership is now starting to go in the wrong direction. And this company has basically never bought back shares since it went public back in the 80s. You can see how it's consistently went up year after year after year. Now that's the first reason, but the second reason is the big one. Now, before we look at this chart, before we look at numbers, let's go ahead and look at the graph that they show. Now, first off, they said that 14.69 billion is going to be maturing within the next year. And if you compare that to the revenue, out of the billions of revenue that they have, let's look on an annual basis. Annually, they do right around 133 billion. So already over 10% of that is going to be maturing in debt within the next year. And that's not even factoring in their day-to-day operating expenses. That's just long-term debt. Over 10% of the revenue is going to be coming due just this year. Now, obviously, that's not it. They have a lot, and I mean a lot more debt. This company has always had a lot of debt, but as of lately, it started to get insanely high. It's crazy. So let's slowly scroll through. I'm going to set my automatic little mouse scroller here, and you can see how all of these years of debt is going to add up to a massive debt pile. When I get to the end of this, you're going to see how big it really is. Now, another thing I want you to look at while I'm scrolling through this is some of the interest rates. Some of them are very good. Some of them are very low in the 0 to 1% range. Now, some of them are higher, 4, 5, 6, 7%. I think one is even high as 9 if I'm remembering correctly, but I see one right there, 7.75 and a 7.875% that is due by 2032. Now, here's the important part. Verizon did finance a lot of this debt at extremely cheap interest rates. Most of it is fixed, a couple of them are variable. So first off, as interest rates rise, the variable is going to become more costly and cash flows are going to be harder to come around. Notice how some of the longer term stuff here, as we're getting further out, almost all of it is 4 and 5% plus. Now, the reason that this is so risky is that over time, as this becomes due, you see that this was all financed at incredibly low rates. Even this, getting this far out, is so low compared to how normal long-term bonds like this work. If this company in the future, whether that be 5, 10, 15, 20 years from now, if interest rates stay high, now I'm not sure that they will, I think that long term they probably will go down, but if these stay high, if interest rates stay at 4 or 5% on the terminal rate, they were to have to refinance these deals at 6, 8, 10, 12% interest rates, and that would not be healthy for a company like this that is already drowning in debt. Now, you might be looking at all these long-term bonds and thinking, wow, that's a lot, but when it really becomes apparent is when you put it on charts side by side. Now, let's look at the cash. The cash is very negligible. You can see that the cash as the most recent quarter is right around 2 billion, which is right around the average. They normally stay right around 2 billion on the long-term average. However, the debt pile over time has gotten bigger and bigger and bigger. The peak back in the early 2000s during the dot-com bubble was right around 45 billion. And that seemed like a lot at the time. And they spent years, almost a full decade trying to pay it off, and they lowered it from 45 down to 30. You saw another big ramp up from a big deal back in 2009, and they ramped it up to 60. They tried to slowly pay it off. They trickled it down some. until you got to 2013, 2014. You thought 60 was a lot, then they raised it up to 110. They pretty much doubled it. And it stayed flat. It pretty much went nowhere for years on end. And then they finally started to pay it off. And then that brings us to where we're at today in 2020 when they did another massive debt raise. You thought that the high number of 116 billion was a lot. Well, at one point, this company's debt peaked at 146 billion. Now they have been paying it off. They've been paying it off quickly. They've been focusing on paying off that debt, which is very, very important for a company with this big of a debt pile. But when you compare the green by the red, the cash by the long-term debt, it becomes extremely apparent how indebted this company is. 2 billion versus their long-term debt of 129 billion. That is insane. And so the reason why I have to sell this company is because if you're wanting to own a stock like this, it is not one that I can personally sleep well at night. Now, while the revenue is reliable, I can look at other companies that are not nearly as debt-ridden, which is the one that we increase, which is McDonald's and Coca-Cola. If you look at its debt, it is pretty healthy. It does have a lot of debt, but when you consider how reliable it is and how much less leverage it is than Verizon, it's not nearly as risky in my opinion. They have about 13 billion in cash as of the most recent quarter, but their 13 billion is compared to 35 billion. So it's about 2 to 3x the size of the cash pile, but when you compare that to Verizon, it's just insane, including the other company we raised up, which if you look at their balance sheet is actually a lot less healthy, but even then it's not even remotely close to what Verizon is. They have the same pile as Verizon, right around 2 to 3 billion, but their debt pile is only 34 billion. 34 billion is a lot, and I'm honestly not a huge fan of that, but when you compare the 34 billion versus Verizon's astounding 129 billion, it's not even in the ballpark. So it's for these reasons I want to sell Verizon: the lack of revenue growth, the lack of profitability growth, and overall the rising dividend with growing shares outstanding and the growing debt pile. It's just not one that I'm confident in. And at the end of the day, it doesn't come down to what I think is going to make the most money. It is a big part of it, but part of it also is emotional. Emotions are very key in your investments, and if you cannot be confident with your investment strategy, if you cannot go to sleep at night knowing that these companies are safe, I'm just not that way with Verizon anymore. So we decided to increase the position in Coca-Cola and McDonald's, which we're at a historical low at 1% of the portfolio, which we need to get back to a small core holding of 2%. So that's why I sold them, that's why I increased the others, and that's my opinion on Verizon stock. Thank you guys so much for watching, checking out all the stuff down below in the description if you haven't already. Get $10 for getting signed up on the One Finance. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.